Hi, and welcome to another episode of the Golden Truth. My name is Dave Kranzler, and with me silently in the background is my co-producer, John Titus. Before I get started on today's topic, I just wanted to mention that John is working on a blockbuster video about the Eric Holder resignation. There's a lot of things going on that are not being reported and have not been reported in the media. And John has done an incredible job digging up information that, just to say, I've seen most of the initial script and it makes my blood boil what's going on in DC. At any rate, I wanted to discuss the housing market right now, and the reason for this is I think there's a unique opportunity to make a lot of money in the stock market if you're willing to take a short position in home builder stocks. It's a long-term trade, but almost no one is watching this, and I think I'm one of the few guys out there who's writing about it on my blog. And what's happened is we had a massive housing bubble that began in 2000 basically. It popped in 2005, and we've had a dead cat bounce that's was essentially stimulated by a couple $1 trillion in Fed stimulus and aided by taxpayer money courtesy of the government. At any rate, John and I have produced a video in which I go through the basic variables that have caused a dead cat bounce and why it's headed south again. This is unfortunate because obviously the housing market is a big part of our economy, and for most people, the bulk of their net worth is tied up in their home, and unfortunately, I think a lot of people are going to be disappointed when this thing goes crumbling back down, and I think it's heading south again already. So the video is going to start now, and I'll have a few things to say at the end of it.
The housing market is in a long-term secular bear market that began in mid-2005. Homebuilder stocks peaked in price in July 2005. Sales volume and homebuilder sentiment hit all-time highs shortly thereafter. What has been marketed by the housing industry associations and Wall Street as a housing market recovery is nothing more than a standard bear market dead cat bounce in sales volume and prices, which was fueled by over $2 trillion in direct and indirect stimulus by the Federal Reserve and the federal government. The biggest problem with calling what has occurred in the housing market a recovery is the fact that the home ownership rate for the entire United States has been declining at a sharp rate since early 2005. Making the situation even worse is the fact that the largest drop in home ownership has occurred in the under 35 age group. This is predominantly the first-time buyer segment of the market. Historically, first-time buyers make up 40% of the demand for homes. Currently, first-time buyers comprise just 29% of this demand. The traditional first-time buyer is no longer able to make the down payment to buy a home or has an income level high enough to support the monthly costs of home ownership. According to the government's own Freddie Mac, over the past 4 quarters, all the growth in net household formations has been among renters. The decline in home ownership rates has been primarily concentrated among younger households. For example, in the 35 and younger age group, the homeownership rate has fallen from 43.6% to 35.9% over the past decade. If potential home buyers are not buying, it means that move-up buyers are unable to sell their home in order to move up into a bigger and better home. This dynamic affects roughly 70% of the entire housing market. It is my belief that the dead cat bounce in housing is now over. The Dow Jones Home Construction Index peaked in May 2013, and home sales volume appears to have peaked in July 2013, notwithstanding the statistically manipulated data put out by agencies that report home sales. The decline in volume is largely a product of the large investment buyers pulling away from the market, as many of them have discovered that the income being generated from their huge portfolio of rentals is nowhere near the level that was envisioned by the spreadsheet jockeys who work at these firms. And in the past few months, the individual flippers have declined precipitously, as many of them are now stuck holding homes that they can't sell at the price they paid. The housing bubble peak and the subsequent dead cat bounce can be seen clearly in new home sales volume. New home sales peaked at 1.5 million units in mid-2005 and dropped to 270,000 units by February 2011. The bounce from Fed stimulus took new home sales back up to 459,000 by June 2013, but since then new home sales have been trending sideways to lower. The sales trend for existing home sales, which comprise 90% of total home sales, is even worse. Existing home sales have been declining since July 2013, with sales volume actually negative on a year-over-year basis for the last 10 months in a row, including the just released report for August. The supply of homes for sale is starting to increase at a considerable rate. The inventory of existing homes bottomed out in December 2013. It has been climbing steadily since then. In the latest month's report for August, inventory has moved back up to where it was in 2011. This indicates to me that home sale listings are increasing at a much greater rate, just as sales volume is starting to tank. In addition, from the several home builder company financials I have studied recently, home and land inventory at the nation's largest home builders has gone up significantly in the past 2 years. In fact, at some home builders, amazingly, their inventory is back to where it was in 2005 at the housing bubble peak. Another indicator that the fundamentals in the housing market are starting to deteriorate is that prices are now starting to drop. In July, for example, across 30 large metropolitan areas, an average of nearly 24% of all homes listed for sale dropped their listing price. In several markets, over 30% of all listed homes dropped their price. Demand is also falling quickly. Mortgage purchase applications have been declining almost every week since the beginning of 2014. If applications for mortgages to buy homes are not being filed, it means homes are not being sold. While investors and flippers using cash to buy homes played a significant role in stimulating the dead cat bounce in the housing market, these investors have been dropping away from the market. In June, the latest month for which complete data is available, all cash sales fell to a 6-year low. The most fascinating aspect of the housing market right now is that so few people understand just how quickly it is starting to head south again. I've written 2 very recent blog posts showing hard evidence that prices and volume are starting to deteriorate quickly. In fact, I believe the entire housing market may have hit the wall in August. With the housing market fundamentals quickly deteriorating, the homebuilder stocks are more overvalued now in relation to their revenues and income than they were at the peak of the bubble. What's most astonishing is that no one in the investment community seems to be aware of just how overvalued these stocks are, but the homebuilder stocks are sending us some unmistakable signals. For instance, the Dow Jones Home Construction Index recently has done the nefarious death cross. This is a technical analysis event that occurs when the 50-day moving average crosses below the 200-day moving average. It is considered to be a very bearish trading signal. When you combine bearish technicals with deteriorating fundamentals, it is likely that the homebuilder stocks are going to move a lot lower from here. This is why homebuilder company insiders have been aggressively dumping their company's shares for the last year.
With so few eyeballs watching this segment of the stock market, and with Wall Street analysts always promoting the bullish story regardless of how obvious it is that being long is wrong, there is an opportunity to make a lot of money playing the short side of the housing stock market. I have 4 homebuilder research reports on my blog that show exactly why these homebuilders are extremely overvalued. In addition, I go into detail showing the misleading accounting being used by these homebuilders to boost their reported net income. Incredibly, almost everyone I look at now has the same amount of debt that they had in 2005 when the housing market the bubble was at its peak, and yet their sales volume is 1/3 to 1/4 of the sales volume they had back then. Now, if you're not comfortable shorting stocks, I have a section in each report which discusses basic option strategies you can use to replicate shorting the stock. And finally, I offer some basic trading and capital management ideas and techniques because the sector tends to be volatile. When the stock market finally heads south, which it will eventually, it will exert particularly brutal downside force on the home builder stocks. I hope you have found this video informative, and I hope you take advantage of the research reports I offer on my blog, because I'm highly confident there's a lot of money to be made shorting the home builder stocks. At the very least, I hope you understand that it is crucial to not have money exposed to the long side of this sector. So what this means, if you own mutual funds that have a heavy exposure to the home builders, get out now.